Understanding marginal revenue, a comprehensive overview. Marginal revenue is a crucial concept in economics and business that helps companies optimize their production and pricing strategies. Defined as the additional revenue generated from the sale of one more unit of a good or service, understanding marginal revenue can significantly impact a company's profits and decision-making processes. Key takeaways about marginal revenue. Definition: marginal revenue represents the incremental change in earnings resulting from the sale of one additional unit. Importance for companies. Analyzing marginal revenue helps businesses understand the revenue generated from each additional unit sold, allowing them to make informed decisions regarding pricing and production. Graphical representation. Marginal revenue is typically depicted as a downward-sloping line on a graph, indicating that to sell more units, a company must often lower its prices. Profit maximization. Companies aim to produce goods up to the point where marginal revenue equals marginal cost. When marginal revenue falls below marginal cost, production may be halted as selling additional units would result in losses. The role of marginal revenue in economics. Marginal revenue is grounded in economic theory and plays a vital role, particularly in the context of competitive markets. In perfectly competitive markets, firms cannot set prices above the market equilibrium and will keep producing until the cost to produce the last unit, marginal cost, equals the revenue earned from selling that unit, marginal revenue. This equilibrium is essential for profit maximization and resource allocation. Diminishing returns and marginal revenue. According to the law of diminishing returns, as production increases, the additional output produced from each input will eventually decrease. In terms of marginal revenue, this means that as a company produces and sells more units, the additional revenue earned from selling each additional unit may diminish. This phenomenon highlights the challenge companies face when trying to expand their production in a saturated market. How to calculate marginal revenue. The calculation of marginal revenue can be simplified into a formula. Backslash text, marginal revenue, equals frac, text, change in total revenue, text, change in quantity. For example, consider a company that sells 100 units for a total of $1,000. If the same company sells 115 units for $1,100, the marginal revenue for the additional 15 units sold is calculated as follows. Total revenue from 100 units, $1,000. Total revenue from 115 units, $1,100. Change in revenue equals $1,100 to $1,000 equals $100. Change in quantity equals 115, 100 is equal to 15. Thus, the marginal revenue per additional unit sold is $100/15 is almost equal to $6.67. Understanding positive marginal revenue. While positive marginal revenue is a good indicator of healthy sales growth, it alone doesn't determine profitability. A company must also consider the costs associated with production to make smarter decisions. The marginal revenue curve. The marginal revenue curve is a graphic representation that illustrates the relationship between price, quantity sold, and marginal revenue. Downward sloping line. The typical downward slope reflects how, generally, as price decreases, quantity demanded increases. For instance, to sell more units, a company often needs to lower prices, which subsequently decreases the marginal revenue for each additional unit sold. Intersection with marginal cost. The optimal production level occurs where the marginal revenue curve intersects with the marginal cost curve. This intersection point signifies the level of output where the company maximizes its profits. Average revenue versus marginal revenue. Marginal revenue is often assessed against average revenue, which is calculated as total revenue divided by the total quantity sold. In perfectly competitive markets, marginal revenue typically equals average revenue, due to price-taking behavior. In imperfectly competitive markets, though, a firm may lower prices to sell additional units, resulting in marginal revenue being less than average revenue, leading to different shapes for the revenue curves. For instance, if a company sells one unit for $100 and sets a price of $90 for the next unit, its marginal revenue for that second unit is $90, while the average revenue after selling both units becomes $95. Practical applications and examples. Revenue schedule example. To aid in calculating marginal revenue, companies often use a revenue schedule, which provides a clear breakdown of total revenues at varying levels of production. Here's an illustrative example. Quantity sold, market price, total revenue. $10 $9 $90. 11 $8.50 $93.50. The marginal revenue earned from selling the 11th unit can then be deduced, $93.50, total revenue for 11 units, $90, total revenue for 10 units, equals $3.50. This structured approach enables firms to know precisely how much they gain or lose when increasing production. Conclusion. In conclusion, understanding marginal revenue is fundamental for businesses aiming to maximize profits and efficiently manage production levels. By analyzing how additional sales impact revenue, companies can strategically set pricing, adapt production schedules, and ultimately enhance their operational effectiveness in both competitive and imperfect markets. The analysis of marginal revenue, alongside its relationship with marginal cost and average revenue, provides a robust framework for sound business decision-making and market strategy.